Mortgage stress rose again in July, so today we look at the latest numbers and discuss the reasons why. Hi, I'm Martin North, Principal of Digital Finance Analytics. According to our latest analysis across the nation, we estimate that more than 820,000 households are now judged to be in mortgage stress, and that compares with 810,000 last month. This equates to more than a quarter of all borrowing households. Of these, around 20,000 are in severe stress, and we estimate that nearly 53,000 households risk default in the next 12 months, which is a slight fall from the results last month. The main drivers of stress are rising mortgage rates and living costs, whilst real incomes continue to fall and underemployment is on the rise. This is a deadly combination and is touching households across the country, not just in the mortgage belts. On the other hand, employment remains strong in New South Wales in particular, so income rose a little, and small reductions in some owner-occupied mortgage rates also helped. This analysis uses our core market model, which combines information from our 52,000 household surveys, public data from the RBA, ABS and APRA, and private data from lenders and aggregators. The data is current to the end of July 2017. We analyse household cash flow based on real incomes, outgoings and mortgage repayments. Households are stressed when income does not cover ongoing costs, rather than identifying a set proportion of income, such as 30%, going on the mortgage. Those households in mild stress have little leeway in their cash flows, whereas those in severe stress are unable to meet repayments from current income. In both cases, households manage this deficit by cutting back on spending, putting more on credit cards, and seeking to refinance, restructure or sell their home. Those in severe stress are more likely to be seeking hardship assistance and are often forced to sell. Flat incomes and underemployment mean rising costs are not being managed by many, and when added to rising mortgage rates, household budgets are really under pressure. Those with larger mortgages are more impacted by rate rises. The latest debt-to-income ratio is at a record 190.4, so households will remain under pressure. Stressed households are less likely to spend at the shops, which acts as a drag anchor on future growth. The number of households impacted are economically significant, especially as household debt continues to climb to new record levels. We continue to see the spread of mortgage stress in areas away from the traditional mortgage belts. A rising number of more affluent households are also being impacted. Regional analysis showed that New South Wales has 225,000 households in stress, Victoria 230,000 compared with 218,000 last month, Queensland 145,000 up 4,000 and WA 108,000 up 2,000 from last month. The probability of default fell a little, with falls of about 1,000 households from last month in New South Wales and Victoria, thanks to improved employment prospects. But there are still around 10,000 households at risk of default in WA, around 10,000 in Queensland, 13,000 in Victoria and 14,000 in New South Wales. Probability of default extends our mortgage stress analysis by overlaying economic indicators such as employment, future wage growth and CPI changes. Across the nation, the third highest at risk postcode is 6065, which includes Hocking and Manly in WA, with around 260 households risking default and 6,700 in mortgage stress. Another WA postcode, 6210, which includes Meadow Springs and Dudley Park, has 380 households at risk of default and 1,500 in mortgage stress. Whilst the most at-risk postcode across the country at the moment is 3977, which includes Cranbourne and Devon Meadows in Victoria. There, 390 households risk default and 3,200 are in mortgage stress. You can read more about our analysis of other postcodes on our website, where we discuss the top postcodes in more detail. Households in stress or risk of default would do well to draw up a household budget, as many do not have a clear view of where they stand. and prioritise how they are spending their cash. Many will put more on credit cards, which is expensive, or seek to refinance their loans, but neither strategy is that effective in dealing with persistent cash flow shortage. Those in difficulty should reach out to their lender, as banks have an obligation to assist in cases of hardship before they are forced to consider a forced sale. One thing is for sure, if mortgage stress is about, it is worth being proactive in tackling it rather than just hoping it will go away. In the current low-income growth, high cost of living and rising mortgage rate environment, that is unlikely. If you found this useful, do subscribe to receive our updates. And thanks for watching.